What if I told you that right now, while you're watching this video, there are regular people collecting passive income checks every single month from just 2 investments, and some of them started with nothing more than $1,000? No, this isn't some crypto moonshot or a get-rich-quick scheme from a TikTok ad. This is a dead simple 2 ETF strategy that Wall Street professionals actually use, and it's quietly turning everyday Americans into income investors without them needing to pick a single stock or stare at charts all day. Here's the thing, most people get completely wrong about building passive income. They think you need $100,000 sitting in the bank before you can even get started. They think dividends are for old rich guys in golf carts sipping martinis. And that's exactly why most Americans still have their savings in a regular bank account earning a pathetic 0.39% per year. Let me put that into perspective. You leave $10,000 in a standard savings account, and after an entire year, the bank hands you back $39. That's not even enough to cover a decent dinner for 2 at Applebee's. Meanwhile, the bank is taking your money, lending it out, and making a fortune off of it. But what if those exact same dollars were actually working for you inside the strategy I'm about to break down? Stay with me, because by the end of this video, you're going to know exactly which 2 ETFs to buy, how much to put into each one, and the real math behind turning a $1,000 investment into over $130 a month in passive income. You don't need a finance degree or a Wall Street connection to pull this off. All you need is a brokerage account and a bit of patience. So what are these 2 ETFs? Let me introduce you to your new best friends in the investing world. The first is SHD, the Schwab US Dividend Equity ETF. The second is JEPI, the JP Morgan Equity Premium Income ETF. It's dividend, they form what I call the perfect beginner dividend portfolio. Here's the split that makes it work. You take your starting money and put 60% into SHD and 40% into JEPI. That's an enormous increase in distributions over roughly 14 years. The fund holds around 101 carefully selected U.S. companies, and every single one of them must have at least 10 consecutive years of paying dividends just to qualify for inclusion. We're talking about household names like Lockheed Martin, Chevron, Verizon, ConocoPhillips, and AbbVie. These aren't speculative penny stocks or meme trades. These are blue-chip, cash-generating machines that have been faithfully rewarding shareholders through recessions, pandemics, market crashes, and every kind of economic turbulence imaginable. And the expense ratio? A microscopic 0.06%. For every $1,000 you invest, you're paying just 60 cents a year in fees. You literally spend more than that on a pack of gum at the checkout counter. Here's where the compounding story gets even better. SHD's 10-year dividend compound annual growth rate sits right around 11%, which means your income from this fund roughly doubles every 6 to 7 years without you lifting a single finger. You're not just collecting a static paycheck that stays the same forever. Your paycheck keeps getting bigger every single year automatically, like getting a raise you never had to ask your boss for. Now here's where the strategy gets really interesting for people who want cash in hand right away. SHD pays quarterly, which is great for long-term wealth building. But what about that monthly income you want hitting your account right now? That's exactly where JEPI steps in and fills the gap. JEPI is your monthly cash flow machine. While SHD is quietly growing your income over the long haul, JEPI puts real money in your pocket every single month like clockwork. This ETF pays distributions 12 times a year, and its current yield sits around 7 to 8%. As of early 2026, it's hovering near 8.3%. So how does it manage to pay investors that much without being a scam? JEPI uses a professional-grade options strategy called covered calls. In plain English, JP Morgan's expert team buys a diversified portfolio of around 124 large-cap high-quality American stocks and then sells call options on the S&P 500 through financial instruments called equity-linked notes. Those options premiums generate extra income on top of regular stock dividends, and that combined income gets passed directly to you as monthly distributions. It's the same strategy elite hedge funds charge 2 and 24, except you're getting it inside a single ETF with just a 0.35% expense ratio and the full backing of JP Morgan Chase, a firm managing over $44 billion in this fund alone. That's not some fly-by-night operation, that's one of the largest financial institutions on the entire planet managing your money. And here's a detail most people completely overlook about JEPI. Its beta is only around 0.58 compared to the S&P 500, meaning it moves roughly half as much as the broad market on any given day. So when the market drops 10%, JEPI typically drops only about 5 or 6. That's a built-in shock absorber baked right into your portfolio. And it's exactly the kind of protective cushion a beginner needs when they're just getting started and might be tempted to panic sell at the very first sight of a red day in their account. All right, you understand the what and the why behind each fund. Let's get into the part everyone actually cares about. The real numbers, the actual math. You start with $1,000 using the 60-40 split. That's 600 into SHD and 400 into JEPI. At a blended yield of roughly 5.5%, your portfolio generates about $55 in your first year. That breaks down to roughly $4.50 per month. I know what you're thinking. $4.50 a month? That's barely a cup of coffee at Starbucks. And you're absolutely right. But here's the critical part that separates people who build real wealth from people who stay broke. That $4.50 is your proof of concept. It's the seed being planted in the ground. It proves the system actually works with real money in a real account. And once you see that very first dividend deposit land in your brokerage account, something shifts in your brain. You go from skeptic to believer almost overnight. And that mental shift changes how you think about money forever. But this strategy doesn't work if you just park $1,000 and walk away for 20 years. The real horsepower comes from what you do next. You commit to adding just $100 per month. That's roughly $25 a week. Skip 2 takeout meals or cancel 1 subscription you barely use, and you've already got it covered. Then you turn on DRIP, which stands for Dividend Reinvestment Plan. Here's why DRIP is so powerful. Every single dividend you receive automatically purchases additional shares. Those new shares then earn their own dividends, which buy even more shares, which earn even more dividends. It's a snowball rolling downhill that picks up mass and speed with every single revolution. And the longer it rolls, the bigger and faster it gets. By the end of year 1, your portfolio is worth over $13,000. That's your initial $1,000 plus $1,200 in contributions, plus all those reinvested dividends compounding quietly behind the scenes. Fast forward to year 3, and you're sitting on a portfolio worth over $28,000, generating roughly $130 every single month in completely passive dividend income. Let that number really sink in. 3 years of consistency. $100 a month in contributions. And you've built yourself a legitimate income-producing machine that hands you $130 every month without any additional work. That covers your phone bill, your Netflix, your Spotify, and your gym membership combined. All paid for entirely by your investments, not your paycheck. That's what the beginning of financial freedom actually looks like in practice. Now I want to give you a specific milestone to aim for, because having a concrete target makes all the difference when motivation starts to dip. I call it the first 25 milestone. When your monthly dividend income crosses $25, you've officially proven that this entire system works for you personally. That $25 might seem tiny in the grand scheme of things, but it represents something enormous. It's the difference between theory and reality. Between reading about passive income on Reddit and actually experiencing it in your own brokerage account with real deposits, showing up month after month. Once you hit that milestone, your only job is to keep the machine running. Keep contributing, keep reinvesting every penny, and watch that 25 climb to 50, then to 100, and far beyond. But before you rush off to open a brokerage account, I need to warn you about 4 mistakes I see beginners make constantly. Any single one of these can completely derail your progress. Mistake number 1 is chasing insane yields. You'll stumble across ETFs advertising 12%, 15%, even 20% yields, and your eyes will light up like a slot machine hitting 777s. But here's the ugly truth. Ultra-high yields are almost always a trap. Funds offering yields that high are often paying you back your own invested capital through something called return of capital, or they're stuffed with distressed companies one bad earnings report away from slashing their dividend entirely. That sky-high yield isn't a green light signaling easy money. It's a giant red flag telling you to run the other way. Stick with proven sustainable income from quality funds like SHD and JEPI that have the institutional track records to back it up. Mistake number 2 is checking your portfolio every single day. I get it. When you first invest real money, you want to watch it like a hawk guarding its nest. But the stock market goes up and down every single trading day. That's literally what it does. If you check your balance every morning, you are guaranteed to see red days. And when you see red, you'll feel that gut punch urge to sell everything and hide under the mattress. Don't do it. The people who build real, lasting generational wealth from dividends are the ones who set up their system, automate contributions, turn on drip, and check in maybe once a month. Boring is profitable. Boring is how quiet millionaires are actually made. Mistake number 3 is trying to time the market. You'll convince yourself to wait for the next big crash to buy at the absolute bottom. Sounds genius, right? Except nobody, and I truly mean nobody, consistently times the market correctly over the long run. Not hedge fund managers with billion-dollar research budgets, not Wall Street analysts with Ivy League degrees, not your uncle who swears he predicted 2008 at every Thanksgiving dinner. The data spanning decades is crystal clear. Time in the market beats timing the market almost every single time. The best day to start investing was yesterday. The second best day is right now. And mistake number 4 might honestly be the most expensive of them all. Not reinvesting your dividends during the accumulation phase. When you're still in the building stage, every dividend you pull out and spend is a compounding soldier you're permanently removing from your wealth-building army. That $3 dividend you casually blow on a latte could have grown into $30 over the next decade through compound reinvestment. During the building years, reinvest every single penny your portfolio generates. You can absolutely switch to taking the cash later once your portfolio is large enough to genuinely fund the lifestyle you actually want. So here's my question for you, and I really want you to think about this. What would you spend your very first monthly dividend check on? Your phone bill? A nice dinner out with your family? Maybe putting it straight into your kids' college fund? Drop your answer in the comments below because I genuinely love reading what motivates each of you. And if this video made the idea of building real passive income feel actually achievable for the very first time, do me a favor. Hit that like button so the algorithm pushes this to more people who need to hear it. Share this with a friend or family member who's been too scared to start investing. And make sure you subscribe to this channel so you don't miss the next video where I break down exactly how to scale this exact same strategy all the way up to $1,000 per month in dividend income. Trust me, you do not want to miss that one. I'll see you there.